Hello everyone, welcome to PwC's discussion and sensitization on the burden of proof in tax disputes. My name is Janet Lavuna. I'm the Tax Controversy and Disputes Lead at PwC.
Hello, my name is Bismarck Lumumba, an associate in the Tax Controversy and Dispute Resolution team.
Hello everyone, my name is Sidi, an associate in the Tax Controversy and Dispute Resolution team at PwC.
The tax environment in Kenya is becoming increasingly adversarial. It's therefore important for taxpayers to be ready in case Kenya Revenue Authority comes to them to do an audit or an assessment. It's important for a taxpayer to understand the meaning of the word, the burden of proof, so that they are able to provide the Kenya Revenue Authority with the relevant documents in case of an assessment and avoid being unnecessarily charged taxes that they ought not to be held liable to. The term the burden of proof is used to assign evidentiary responsibility between parties in a dispute. This means it is what is used to determine who is responsible to produce evidence in order to support various facts and to prove the facts that they would want to be believed. For us to look at the definition of the burden of proof or what is evidence, we look to the Evidence Act.
In defining the burden of proof, we have to look at the Evidence Act. In particular, Section 107 of the Evidence Act expressly provides that whoever desires any court to give judgment as to any legal right or liability dependent on the existence of facts which he asserts must prove that those facts exist. Section 108 provides for the incidence of the burden of proof and provides that the burden of proof in a suit or proceeding lies on that person who would fail if no evidence at all were given on either side. And so here we see that the burden of proof really is to assign the evidentiary burden.
Under the Kenyan tax regime, there are various taxes. As a taxpayer, you interact with various taxes in your business. You're encouraged to keep documents to illustrate this position. For instance, if you deal with customs, you should keep the manifest and bill of ladings to prove ownership of the goods that you deal with. For VAT matters, you should keep receipts, invoices, and bank statements to show that purchases and sales have occurred in the business. For income tax matters, you can use audited financial statements, trial balances to show the cash flow in your business. For pay as you earn, you can use the payroll register to show the tax position. These are just some of the documents that a taxpayer can use. There are a wide variety of documents that a taxpayer is required to keep and prove their position during a KRA audit or during an assessment.
The general provisions for tax procedures are contained in the Tax Procedures Act. Section 23 of the Tax Procedures Act provides that a person or a taxpayer has a statutory duty to retain all documents that are relevant to their tax affairs. It goes further to emphasize that a person shall maintain any records required under a tax law so as to enable the person's tax liability to be readily ascertained. The section also states that a person should retain records for a minimum of 5 years. However, we recommend that you retain your records for up to 7 years for reasons that perhaps a taxpayer could be going through an audit just before the end of the 5 years and they will need to be in a position to prove their tax position with the documents that go beyond the 5 years.
Tax disputes are unique. They can either have a criminal element or a civil element. Therefore, it is important for us to take a look at how the burden of proof is dealt with in criminal matters and in civil matters. Criminal matters are disputes whereby an accused person has been accused by the state of committing a crime and they are brought forth before the court of law. Here, the prosecution has the burden to prove that the accused person did commit the crime. The prosecution must prove beyond reasonable doubt that the accused did commit the crime. While civil disputes are disputes whereby a party is aggrieved due to monetary loss or breach of contract. The party taking the case to court is the plaintiff. The plaintiff must prove on a balance of probability that it is more likely that the defendant did occasion the loss that occurred. The burden of proof in taxation disputes.
The burden of proof in tax matters is quite distinct and different from other general disputes. As we have seen earlier, that he who alleges must prove, and that is provided for in the Evidence Act. However, in tax matters, although it is the commissioner who gives an assessment, the burden of proof falls on the taxpayer. And we see this from Section 56 of the Tax Procedures Act, which provides that in any proceedings under this part, the burden shall be on the taxpayer to prove that a tax decision is incorrect. Similarly, we see the same in the Tax Appeals Tribunal Act. Section 30 of the Tax Appeals Tribunal Act provides that in a proceeding before the tribunal, the taxpayer has the burden of proving where an appeal relates to an assessment, that the assessment is excessive, or in any other case that the decision should not have been made. And so in tax matters and tax disputes, the burden of proof lies on the taxpayer. We shall see why this is.
So why is it that we say that the burden of proof in tax disputes is unique? It's for the following reasons. As we earlier stated, the burden of proof falls upon the person who alleges. And in this case, the commissioner will raise an assessment and makes the allegation of a tax liability. However, it's the taxpayer who has to disprove that tax liability. That is why it's unique. In a sense, it appears as though the taxpayer is guilty until they prove themselves innocent. To get guidance on where to look for information on why this is, we rely on the case of KRA versus Van Diesel, where the following insights came up. One, there's a presumption of correctness of a tax assessment. Keep in mind that initially a taxpayer files a self-assessment, and that is initially deemed to be a correct assessment. However, the commissioner may come to do an additional assessment or a default assessment, and that is then deemed to be correct or presumed to be correct. The burden is then upon the taxpayer to disprove that assessment. The second reason why the taxpayer bears the burden of proof in tax disputes is because the documents that are required to prove their position are in their possession. These documents are documents generated in their day-to-day transactions, and even the Kenya Revenue Authority relies on those documents to raise the assessments against the taxpayer. So because the documents are in possession of the taxpayer, it is only them who actually can disprove the tax assessment. As you can see, there's a heavy burden on the taxpayer to discharge the burden of proof. However, on the flip side, it's important to note that whereas the law provides that the burden of proof is on the taxpayer, the Revenue Authority is not allowed to generate assessments that are based on speculation. Secondly, these assessments must be founded in law. And thirdly, it's very important to understand that once the taxpayer discharges their burden, the burden then shifts to the Revenue Authority as well to controvert that evidence. And if they don't have evidence to controvert the taxpayer's position, then the taxpayer must succeed. The burden of proof is limited to only production of evidence that is in possession of the taxpayer. The Revenue Authority is not required or is not allowed to insist on being provided documentation that is not within the possession of the taxpayer and is not within their normal business transactions to have. So therefore, again, the Revenue Authority cannot raise assessments that are based on speculation in the hopes that the taxpayer will fail to provide documents to disprove it and then succeed based on that basis.
Another aspect that is pertinent to taxpayers when discharging their burden of proof is to what level must they discharge their burden of proof? And this was discussed in the case of Hickman Motors versus Canada, where the court held that the taxpayer ought to simply make out a prima facie case in discharging its burden of proof, not make out a case beyond all reasonable doubt, not on a balance of probability, but merely a prima facie case.
While the burden of proof lies with the taxpayer to prove that the tax has been paid or that KRA's assessment is wrong, Section 23 of the Tax Procedures Act provides that a taxpayer ought to produce documents. It is important to note that a taxpayer can only produce documents that are in their possession. It's not the intention of the law to have the taxpayer produce documents that are in the possession of third parties. This was the position taken in the case of Shriji Enterprises versus Kenya Revenue Authority and also in the Man Diesel case. Taxpayers are only supposed to avail documents that are undertaken in the transactions that they've undertaken. While KRA requests for documents, they are supposed to request for documents taking in mind reasonableness and the nature of the circumstances of the taxpayer's business.
In conclusion, I hope we've been able to help to unpack this complex legal concept called the burden of proof so that taxpayers can understand the scope of their responsibility in discharging it. We also hope that in future, if a taxpayer is able to discharge that burden, they'd not be charged taxes that they're not liable to. For more information, you can visit our website.